Gold has been breaking record after record, and naturally the big question everyone is asking is this: does a powerful rally like this usually end in a crash? In today's video, I want to share my perspective. Let's begin by looking at where we currently stand. This is a one-year chart of gold prices, and during 2025, gold surged roughly 64%. To put that into perspective, the S&P 500, shown here as the blue line, gained about 16% over the same period. So gold didn't just perform well in absolute terms, it dramatically outperformed stocks. Now, when you look at gold's movement over the past year, the uptrend looks fairly smooth and controlled. Honestly, it doesn't appear alarming at all, but once you zoom out and examine a 30-year chart, the picture changes. The scale of the move suddenly looks extreme. To many investors, this kind of long-term surge feels unstable and vulnerable, and understandably so. Prices can't rise indefinitely, or can they? To explore that question, let's step back even further and examine a 50-year chart of gold and review what has happened during past peaks. The most well-known collapse in gold prices began around 1980. Throughout the 1970s, gold prices skyrocketed due to runaway inflation, oil crises, geopolitical tension, and a severe loss of faith in the US dollar. By January of 1980, gold reached approximately $850 per ounce before falling roughly 65%. Here's the critical point that many people misunderstand. Gold doesn't decline simply because it becomes expensive. Gold falls when confidence in paper currency is restored. That distinction is essential. So what actually changed in 1980? By the late 1970s, inflation was deeply entrenched. Energy costs were exploding, and the public had little trust in the dollar. More importantly, markets doubted whether policymakers were willing to take decisive action. Gold reflected that loss of confidence, climbing steadily for years and then accelerating sharply at the end of the decade. But everything shifted abruptly when the central bank leadership at the time made an extraordinary decision. Instead of slowly raising interest rates, policymakers drove rates into territory that would be unthinkable today, approaching 20%. For much of the early 1980s, rates stayed between 10% and 20%. Imagine mortgage rates near 18%. Some viewers don't need to imagine. They lived through it or heard firsthand accounts from family members. Contrast that with today, where the benchmark policy rate sits around 3.75%, nowhere near historical extremes. The key wasn't just high rates, it was that interest rates were pushed above inflation, creating strongly positive real yields. Holding cash or short-term government debt once again preserved purchasing power. Savers were no longer penalized. As a result, capital no longer needed to seek refuge in hard assets just to survive. Confidence returned. The dollar strengthened as global investors poured back into U.S. assets. Policymakers proved through action, not rhetoric, that they were willing to endure economic pain to restore stability. That pain was real: recessions, high unemployment, and financial stress. But inflation was crushed, credibility was rebuilt, and gold's role as monetary insurance faded. Gold didn't collapse because prices were high. It fell because its purpose diminished. Now let's fast forward to 2011, another period often cited as proof that gold always crashes after major rallies. Gold peaked near $1,920 per ounce following the global financial crisis and multiple rounds of aggressive monetary stimulus. Investors feared currency debasement, so gold surged as protection, but the inflation surge many expected never fully materialized. Globalization, weak wage growth, and excess productive capacity kept price pressures contained. As that reality became clear, sentiment shifted. Around 2013, policymakers signaled an eventual exit from emergency measures. Real yields rose, the dollar strengthened, and risk assets recovered. Gold didn't crash overnight. There was no single catalyst. Instead, prices declined gradually. By 2015, gold had fallen roughly 45% from its high. Once again, the lesson is the same. Gold didn't fall because it was overpriced. It fell because its insurance value was no longer needed. Every major gold downturn shares common traits. Real interest rates turn positive and remain there. The dollar enters a sustained strengthening phase. Trust in monetary management is restored. Gold doesn't respond to technical overbought signals alone. It responds to real yields and credibility. And today, despite price gain, gold remains relatively under-owned compared to other assets. So how does today compare? The current environment is fundamentally different from both 1980 and 2011. First, real interest rates remain negative. Even with higher nominal rates, inflation continues to erode purchasing power across housing, healthcare, insurance, and services. We still can't sustainably reach the official inflation target. Second, government debt changes everything. In 1980, debt to GDP was around 30%. Today, it exceeds 120%. Raising rates dramatically would make debt servicing unsustainable. Third, fiscal policy remains loose. recent deficits approach $1.8 trillion, undermining long-term confidence in the currency. 4. Central banks are accumulating gold at record levels, diversifying away from dollar exposure. This creates a persistent source of demand that didn't exist in previous cycles. Finally, the global system is gradually reducing reliance on the US dollar. That weakens the long-term case for a sustained dollar bull market. So what would actually cause gold to decline meaningfully? A true structural downturn would likely require long-lasting positive real yields, serious fiscal discipline, a strong dollar cycle, central banks selling gold, political acceptance of prolonged economic hardship. Realistically, what downside scenarios make sense? One possibility is extended consolidation, where gold moves sideways for years. Another is sharp corrections within an ongoing bull market. Pullbacks of 15 to 20% can and will happen. The final scenario, a prolonged bear market, would require policy choices that today's political and debt realities make unlikely. We live in a financial system built on fiat currency, unconstrained by physical backing. History shows that while gold can experience volatility, currencies backed by nothing ultimately lose value over time. So the takeaway is simple. Gold doesn't fall because it reaches new highs. It falls when trust in fiat money is restored. That requires real returns, discipline, and credible action, conditions that are not currently in place. Gold won't rise in a straight line, but understanding history correctly matters. If you want to see how I'm positioning personally, you can check out the link below. Thanks for watching, and have a great day.